Welcome to tonight's class. So once again, good evening. You are welcome to Apex Professional and Associates class for today. We'll be having a look at some concepts in chapter 2 that we could not finish last week, Wednesday, when I handled this course. Ordinarily, like I said the other time, I supposed not to be your tutor. So fine, every class is supposed to have at least minimum of 2 persons that will take them. But Mr. Idris was the one that assisted us the other time, the other diets. But this time around, they need small hand so that we would cover the syllabus in a more simpler way. So ordinarily, today, you're supposed to take class, but he called in busy. And then I do not want us to give excuse. Since I started a topic the other time, we've not finished. So let's just continue that topic for today. So before we start, I'm going to allow you guys to say some things and then give us some reflection about the previous classes, the one I had with you guys. I think the other time I took, please, if you have something to say, raise your hand, right? I do not want a rowdy class, please. So the last time I took class was on Wednesday, and then we had a look at chapter 1 and then chapter 2, but we did not finish chapter 2. So before Mr. Idris now came on board on Friday to take you, I think, chapter 3. Chapter 3 was a very long chapter and it took 3 hours thereabouts. So, what are your reflections? We've asked about your expectation the other time. This time around, we just want to hear 1 or 2 things from you guys regarding our classes, and then maybe some few clarification that you want to make, just for 2 or 3 minutes. I'm going to accommodate maybe 2 or 3 persons. Rahim, you raise your hand. Mute yourself and then say something.
Sorry, sir, that was a mistake. I don't have anything to say.
Okay, that's fine. So I'm not seeing any hand. Okay. So, okay, that means people are fine. Okay. I think we should just start the class in a lighter mood so that we can cover up. So today we'll be having a look at money laundering as a concept, right? And from there, we are going to move to chapter 4 and have a look at auditors' responsibilities and liability, a very wonderful and interesting topic. So please, I will be urging you, please do not be missing classes. You have opportunity that you're having a quality free class. Our style design is going to be very unique in a way. Money laundering is the remaining of chapter 2. Our style this time around is going to change a bit, and what it means is that we are discussing with the tutors to see how we would organize a revision classes for all of our courses, which will be paid for, so that you guys can enjoy more and then have a good preparation time for examination. Please, except you are allowed, do not unmute yourself, please. If you have anything to say, just raise your hand. So if you are unmuting yourself, a bit already, I will take it as if you are not following the rules and regulations of the classes. So, and the class has to be very orderly and then without any disturbance. So let's be very, very attentive. And so money laundering. It's the remaining of chapter 2 that we did not finish last week Thursday. Last week Wednesday. Okay. From a layman's language, who can tell us if we say, okay, money laundering is not new, right? It's not new. What is money laundering? How can you explain it? Ignoring what I'm displaying on the screen. Can someone help us out on this? Please raise your hand if you have something to say. Babalola Amavukola Suliat. Money laundering. What do you want to tell us about it?
Yeah, good evening, sir. Can you hear me?
Good evening.
Yeah, thank you, sir. Actually, I've been raising my hand.
So what you do is that you will tell us your name and where you are joining from.
Okay. My name is Amavukola. I'm joining from Nigeria. So, actually, I've been.
Okay. Sorry, Nigeria where? Nigeria where? We know majority of people on this call are joining from Nigeria. So it's just to actually grasp each people's opinion. But it's fine. You can go on.
Yeah, thank you, sir. So actually, I've been raising my hand since before you asked about the money laundering. So regarding the her view, am I still permitted to say like my own view?
Go on.
Okay, thank you, sir. Okay, like fine. You had chapter 1 and 2 we thought, which was quite interesting, and another lecturer also had chapter 3 we thought, which was quite interesting. But my own is, if we'll be having like different lecturers now, is it that if one stop a chapter like for this chapter, another one will follow, or each lecturer has their own chapter they are giving us, and the other one has their own chapter they are giving to us?
Yeah, well, anyone is fine.
Anyone is fine.
So anyone is fine. So but we will just be doing what we will just maintain is to maintain a flow in those chapters. So another thing we could do is to say, okay, one person will take from chapter 1 to 7 or chapter 1 to 8, and that will take from chapter 8 to the last chapter. So we could also do that. But because who is that? Abba Victoria, you are disturbing my class. So another style we could use is to say, okay, let one person take this class, let another person take from here to the last. But because I did not prepare, I was not supposed to be a lecturer for this particular. I'm only filling in because Mr. Idris was not chance last week. This week as well, he said it's not chance. So I do not want to give excuse. And that's why I'm filling it, right? So apparently people reach out, they be like, hey, can you continue? I said, guys, I'm very, very sorry. I do not have that chance. In fact, this particular one, I got in maybe like 10 minutes to the class. So I just have to quickly glance through the topic where we stopped the other time and cover up. So the time is not there. But it's fine. Let's see how it goes, Sha. After you may be seeing me more often in your classes.
Okay, that's fine, sir. Thank you so much, sir. Okay, then yeah, for money laundering.
You're welcome.
For money laundering, it's just like the process of getting money illegally and investing it in a business to make it look like as if the proceeds from that business, like to make it look like as if the money is gotten from a legal source, and also making it difficult to trace such a transaction, like investing in real estate and the like.
Okay, that makes sense. Thank you.
Yes, sir.
Mabukola, that's a nice one. You can lower your hand if you're not done that before. You can also mute yourselves. Ahmed Ibrahim, your name and where you are joining from. And tell us what money laundering is.
Good evening.
Good evening, Mr. Ahmed.
My name is Ahmed Ibrahim. I'm joining from Katsina State.
Katsina, okay.
All right. Money laundering is the process of, in a layman language, cleaning illegal gotten money to make it look as if it was gotten from a legitimate source.
Okay, that makes sense in a layman's language. Okay, let me take one more. Let me take one more. I can see 6-2 Ukachi. 6-2 Ukachi. Your name and where you are joining from, and your view about money laundering.
Good evening, sir.
Good evening, Augustus.
My name is 6-2 Ukachi. I'm calling from Musuka.
Joining from Musuka, okay?
Yes. Money laundering is a sort of financial transaction that is concealed in such a way that the source of the funds cannot be easily traced to the parties involved in the transaction.
Okay, you all have said well. Thank you. Thank you, Mr. Sisters. Thank you, Mr. Sisters. Okay, let's continue the class. Let's all mute ourselves. So all you have said well. Money laundering, as the name implies, you say laundering. So laundering is to wash something, it's to clean up. Say, it's into laundering service. That means it's into a cleaning service. Maybe washing clothes, fabrics. It might be general house cleaning, like laundering. So when we now add money to it, so it means it's a form of cleaning the money. So we are in a age whereby people get money through different sources, right? And they make this money to look real, look good to one, to the public, two, to the financial institution who are the custodian of finances, and three, to the government, whose responsibility is to trace and also make sure that things are done in the proper manner. So from what we wrote here, we said this is an act of making an illegal source money appears as if it's earned legitimately. That means before someone can launder money, you have to commit a crime. That's what it means. So if you are getting money from an illegitimate source, you are a criminal. You are a criminal. Let's leave it as it is. You are getting money from an illegal source, you are a criminal. So one need to commit a crime. That's the first thing. Let's underline that. You have to commit a crime. So, and then make money in an illegitimate manner. So after then, you now cover up in order to spend the money. So you have made this money, the money is huge. So carrying out maybe a fraud in any name that it is, and now you have made this money, you want to spend the money. So, and money by nature, it makes noise, right? You spend money, people will ask, you spending money, where did you get the money? It's living a lavish life, an extravagant life. The question down comes, society will ask you, they will ask some questions. They will be sniffing around, where has it gotten the money is spending? What does it do? They'll be like, doing one petty job. So this is the job he's doing, and he's spending like this. Then questions then arise. Could he be doing something else that is not legal? And he is now pushing the money into a legitimate business. And that is why in the era we are now, you will see one thing or the other and be like, why? Where are you getting this money? Is it not the same thing as we are also doing? So a whole lot is going on in the financial industry. So now let's go to the steps. Steps in money laundering: placing, layering, and integration. The first one, let's explain. After someone has made an illegitimate money, the first thing to do is to place it into your company. So that's the first thing. Okay, fine. we are learning this. Why are we learning this? Is for us to know and to be able to identify when there is a potential money laundering activities. We are accountants. We are custodians of records, financial records. So it is our own responsibility to ascertain, to pinpoint when something like this is going on. Why? Because a money laundering activity is a criminal activity, and we do not want to be caught unaware or be found guilty or looks as if we are aiding and abating that activity. Do you understand? So that is the essence of doing this. That's the essence of doing this. So that's the essence. The first thing is to say, okay, you get this money, look for a company, whether a small company, then inject the money into this. So the company will look and say, okay, you are the controller of the company, or you are the owner of the company, or you are a director in that company. So, and you not pretend as if it's part of sales or revenue. So our sales is part of sales revenue. So people just be saying that this revenue making 5 billion in a year. Last year they make 6 billion, and they are telling us that they are selling, they are maintaining a restaurant business. So the questions, you're asking questions. You open a supermarket and your revenue for a year, you're telling me that the revenue is 5 billion naira, 6 billion naira. How? So it will not match up. So that's the essence. That's the first step, to place it in a company so that you control or you own, and you will now report the money you make illegitimately as if it is made from that business. That's the first step. The second step is layering. The second step, which requires someone to use cash to create a trail of transactions, make it complicated as possible, and involve multiple countries. So this is the second step, and this is where financial institutions come to play, because you cannot save, you cannot withdraw, you cannot transfer without them. So they are the medium. So it's to layer in. So you put in those money, breaking it into different components, right? And then make it look complicated as possible by moving it around. Sometimes they move it around different countries so that it will look very, very complicated for people to trace. That's the second step. The third step is integration. So at this stage, the money has been introduced into the business and also moved around multiple countries or systems. So the next thing is to not take it from the business and spend it. Now they want to spend this. They want to bring those money out from the business that looks real, that they can spend it. So they can spend this either maybe through dividends or salary or bonus. They shall have to spend. The essence of money, why are we making money, is to spend money. We are not just making money for money's sake. Who is not disturbing my class? Who is that person? So we are not just making money for money's sake. We are making money so that we can spend. So now they have made the money illegitimately. They have placed it into a company. Now they have layered in the sense that they have moved the money around different systems, different accounts, different countries, so that it will look as if, okay, people will not be able to trace it. And now they want to integrate it, bring the money out from a say legitimate company and spend it in the society. So by the time you now start to spend, when people ask questions, you'll be like, oh yeah, I do this is what I do. This is what I do. So that's the step. So it's very, very important. I can't do this. Let's take it seriously. So okay, now why auditor's responsibility regarding money laundering? As an audit firm, you need, myself and you, we are potential audit firm owners. You guys are chartered accountants to be. You either work in an audit firm, some of you, or you own a license to practice on your own, whether sooner or later, right? So this concerns you. Why do you need to know about money laundering? So is it for you to be able to also launder money yourself? Or why? These are some of the reasons. The first one is to put in place anti-money laundering policy as an audit firm. You are an audit firm. People will be coming to you to come and audit their book, to prepare the accounts for them, sometimes to perform some business solution, consultancy service, tax services, a whole lot of services. They'll be coming to you to do that. And these companies that are coming to you, some of them, their hands are clean, some their hands are not. That's the truth. So, and this is where you now come. The first thing, to put in place anti-money laundering policies. So the policies to say, okay, this company, if you see some of these triggers or indicators, it triggers that something could be going on in that particular company, so that you wash your hand. You may decline that service in order for you not to be sanctioned or put your reputation at risk. That is number one. Number two, to check identities of your clients, the major shareholders and the directors. That is where KYC comes in. Know your clients. Know your clients. So you have to be able to know who your client is. And if you're saying clients, who are behind those companies? Who are the owners? And who are the directors? Who are the top management? Very, very important. Number three is to understand the client's business model. What do they do? Try and understand. Okay, what do they say they are selling? They are into restaurants. Okay. So they still commensurate with the money they are making, with the transaction that is going on. Hope it's not that money is just moving from one account, they're just doing around tripping. Money is just moving from one account to another account, all in the name of saying they are selling something. So you have to understand what is their business model. So that if anything is going on, you would be able to understand, to say, okay, some business model, they are going to put it in a way that is so complicated and uneasy to understand. Or if you're not to now say, okay, this is not right. That's number three. Number four is to keep records of their activities in case an issue arises. So you use that records to defend yourself. Appoint a money laundering reporting officer, MLR, who sets up the firm's money laundering policy. It might be a senior partner, or maybe one partner that is in charge of risk, right? So we'll be doing that. Train all staff in money laundering laws and clues. You have to make them aware. So, okay, what is your responsibility as an audit staff? We know that most of you work as an audit trainee, an audit senior, audit staff, an associate, a manager. So, what are your responsibilities? Number one is to report to MLR, the money laundering reporting officer, if there is any suspicion. If you see there is any suspicious activity, you tell them, you inform them, so that they can carry out a further finding. Number two, and the reason why it is your own responsibility, because most of the senior officers in audit firm, the senior partner, the associate directors may not have the chance to say they are not the ones opening the book. It is you that you are going through the book. You are doing the dirty work. So you have more time looking at their book, going through the activities than them. So yes, it is possible that you suspect something. And when you do that, you report to an officer in charge of such in your firm. That's number one. Number two is that do not tip off the clients of such. Anytime you just find that, you do not make the clients know by not asking too many questions. Just leave it. If you're asking too many questions, you are making it look very, very obvious. So they will easily notice that you have suspected something. Okay, laws and regulation affecting clients. So for money laundering, you have more to read. So this is just the major thing that you have to know. And I think there is something I have to mention. regarding money laundering, which is like a current issue in the Nigerian financial system. So there's a SCUML. I think you guys are aware of SCUML, which is a framework that is designed by EFCC, and some organizations they are required to file that and file that with the EFCC. You go to the site, and fill in all necessary information. So amongst the organization establishment that's also this audit firm. So this firm is expected to sign, and without doing it, a whole lot of things will be affected. It will affect your bank accounts. They may put it on suspension if you do not do that. So it's part of money laundering framework, which the larger body that deals with anything that has to do with financial crime has put in place is the FCC. So let's move to another concept here: loss and action affecting clients. Auditors know about loss and regulatory frameworks of their clients because, number one, breaking those laws may lead to ministerial fine. Fine, it is your responsibility to say you are checking financial records, right? But does it stop there? No, it doesn't. And that is what this ISA 250 has come to address, to say, guy, you do not only go to companies that you are auditing, and the only thing you are focusing on is about their books, their financial records. What about the regulatory terrain that they operate in? Are they complying with those regulations, the laws that binds their business, the laws in their industry, the industry that they operate in, the laws of Nigeria as a whole? Tax law is a good example. So auditors are concerned whether you pay the right taxes, though on a high level, right? On a high level. So the reason why you have to be concerned about your client's law and regulation is, number one, is that when they break those laws, it will generate material fines for them. Number two is that if those laws are very serious in terms of compliance, a company upon breach may be closed down. They may close down the company. You are a stakeholder in that company. You are auditing them. You are a business person as an audit firm. You close down your company, it has affected you. It has affected your own revenue and your business as well. So you have to be concerned because you are an important stakeholder. Therefore, going concern threats may be disclosed. So that's number one. Number one is that it affects you as a business establishment. Number two is that it may trigger a going concern threats. If any company that you are auditing flouts a regulatory law, maybe that of NAFDAC, if the company is in foods or drugs industry, and they flout NAFDAC law or SON law or MAN law, Manufacturing Association of Nigeria, and they place a stiff fine on them. So it will affect the going concern threats. It will affect the going concern of the company. So that's why you have to be concerned. So the ISA further states that auditors should, one, obtain a general understanding of the law. You have to understand the law that they operate in. And these are part of primary activities, or let's say exercise, that when you are accepting a client for the first time, you are accepting a new client, that they carry out all necessary information about the client so that you as an auditor, you understand. So I think in a bigger firm, in Big Four, I don't know whether maybe some of the medium four would have that. So there will be a pool like a site, or let's say maybe a link where every single staff that are on particular engagements will go and read about a company, every single thing about them. So, and you have to understand because you're auditing them. Number 2 is to obtain a sufficient audit evidence. You have to understand the law, then obtain sufficient audit evidence. And number 3 is to perform the following procedures. 1, ask whether they comply. You have to ascertain whether they comply with those laws and inspect any correspondence with the relevant authority. How do you know whether they comply? Is to ask. Bring your correspondences, your letters, any letter that FRS has written them in time to say, okay, oh, you are owing us. You would know now if they are fine them, if they are under investigation. Could it be they are complying as they should be? They will open their book for investigation. So that's how you know. That's how you know. You ask, then beyond asking, you also inspect by looking at their files. The files will show the correspondence they have exchanged with the tax with the regulatory body. So the next one is if you don't spot any breach in maybe law or any regulation, what should you do? Number 1 is that you inform the management of the organization through a representation letter. That's number 1. Number 2 is that you inform the audit committee of this. Number 3 is that you inform external regulator by breaching confidentiality, the confidentiality principle, which NOCLAR has now come to address. Fine, as an auditor, you owe your clients the confidentiality, principle by not exposing any of the activities or perhaps maybe their books and numbers to an external party, even the regulator. You report it internally, right? But what if they are not complying? And that is what this one has now come to address. What if they are not complying with laws and regulation? That leads us to the next topic or next subtopic, which has to do with non-compliance with laws and regulation, NOCLAR. So it's relatively new. We are maybe some 8-7 years ago. Before it's now IFAC now has to devise some codes of conduct regarding it. So the IFAC, we spoke about IFAC, I think in the last I think it was still in this chapter 2, chapter 1, in the last class that I had with you. So the IFAC code provides additional guidance for all professional accountants, myself and you, on how to respond when encountering non-compliance with laws and regulation. Non-compliance can be intentional or non-intentional. So a company may deliberately not comply, and sometimes they may not know that they're not complying. Examples of non-compliance that you may come across in some organization or your client's company. Number 1, fraud. Perpetrating fraud. Another example is corruption of practices and bribery. Bribery and corruption are like twin. So one is tied, the other is kind. They work hand in hand, right? Though they are different in a way. Number 2 is money laundering, which we mentioned, which we tweeted the other time. Then terrorists financing and process of crime. So you realize that when you look at their book, you realize that they are playing some games. Their hands are not clean with their finances and the way they move money around. Terrorist financing. And there's a whole lot of money, huge amount of money that people derive from terrorist financing. You would imagine, where are they getting money that they are financing themselves? Some people that are financing them. And process of crime. So securities, market and trading, banking and other financial product services, data protection. So what if they are not complying with all these laws? These are examples. So securities and markets and trading, the SEC placed in some rules and regulation that every company has to follow. What if they are not following it? It's a good example of non-compliance with laws and regulation. Same thing with banking and other financial services. CBN has put in place some regulatory conducts that every single bank has to follow. What if they are not doing this? Right? So, and other financial institutions as well, like insurance, like pension. So they have their regulatory body that regulates how they go. So they have to comply. Data protection. It's also like the current issue which every company now are now inculcating, imbibing. They are doing quite a number of training for your staff and adopt a data protection policy internally. Tax and pension liabilities payments. Some companies are very criminal for this. They will deduct your tax, they will not remit. Small firms they are guilty of this. Small companies, they will deduct your tax, they will not remit. It's a very bad thing. So as an auditor, if you realize that companies, employees, taxes are being deducted and they are not remitting it, flag it. That is a situation whereby you now have to dump the principle of confidentiality. It's no more confidential because some people are not affected. It could be you. So that is why you have to take it seriously. And also pension. Very common. We deduct people's pension. What the law says is that a minimum of 10% should be contributed by the employer and 8% by the employee. That's 10% that they're supposed to the employer supposed they won't contribute that. The 8% of employees that they are also deducting, they will not remit it. So it's not a good thing. So that is why you don't cover this. You have to go. You just have to report. So the next one is environmental protection. This also is gaining quite number of awareness now. But we have to protect our planet, and our planet has to be protected for the coming generation. So, and the last example here is public health and safety. So companies they carry on a quite number of activities that are harmful to the public. So, and if you know about that, maybe the way, and that's why you have to understand the business model. What do they do? What are the things that can actually affect people? And when you see that they're not complying with those rules and regulations, you report them. That is the essence of NOCLAR, non-compliance. You have to just leave the issue of confidentiality or no confidentiality. This is beyond the fact that you are protecting the confidentiality of it. Okay, so what does the NOCLAR framework now explain? It said this is a process to be followed when a professional accountant encounters a suspected fraud or illegal act or any of these circumstances in which a professional accountant would override the principle of confidentiality. Override it. That has to be underlined. You override that principle and disclose the matter to appropriate authority, i.e., you blow the whistle. You blow the whistle. Otherwise, what happened in 2001 /2002 with Aaron may happen to any firm that did not do this. Or perhaps if that does not happen, you may also be looking you may be taking as if you are aiding and abetting wrong actions. All in the name of confidentiality. And that is why the NOCLAR framework has now come. Before now, what is common is that once auditors encounter such issues at the federal above, indicating that this client is non-compliant, he resigns his appointments. That is the initial style. He said, okay, because they are doing this, and our profession is a profession that values integrity, just resign in the name of confidentiality, so that because they know about this and they do not want to interfere or have hand in it, they just resign. However, under this recent framework, auditors cannot simply resign. We cannot simply resign because of identified or suspected NOCLAR, as they used to do before. They are required to address the matter appropriately. So now, what are your responsibilities? How do you address the matter? Your responsibility is that you should obtain understanding of the matter. Understand first so that you won't raise any false alarm. Number 2, advise the management to take appropriate and timely actions. You will report internally first, make them know. Perhaps the management, they are not aware that it's a non-compliance issue. Then rectify and mitigate the consequences of non-compliance. Disclose the matter to an appropriate authority if they do not take any action. What is common in practice is that once you inform the management, they will quickly, swiftly address it before it becomes a source, because they know that if they don't address it, the appropriate authority will know about it, and it will be a messy issue for them. So they will quickly do something about it. Make sure it's properly addressed and the right action is subsequently done. So an auditor may disclose the matter to an appropriate authority if what are the situations whereby an auditor may now go beyond just reporting internally and report to the authority. Number 1, if the entity is engaged in bribery, if it's a bribery case, please, it's not the issue of confidentiality does not work here. You have to take it up seriously. Number 2 is if the entity is regulated and the matter is of such significance that it may threaten its operating license. So if this is a regulated company and that non-compliance issue may threaten the operating license, so you have to report to the appropriate authority if the product is harmful to the public health. So as an accountant, you carry out your activity. We discussed it last week, I remember, in a way that it protects public interest. It protects public interest. So if something is harmful to the public, you have to report to the appropriate authority. If it requires tax evasion is a criminal offense. So they are evading taxes. They are not paying the right taxes. That means they are charging the government. So you have to report to the tax authority. If it requires money laundering, as we explained earlier, you have to bend, you have to jump, put aside the confidentiality principle and make noise. So that's about the remaining of chapter 2. Then we've talked about the money laundering, we've talked about laws and regulation affecting clients. That's at 250 and NOCLAR. So, and that's the first phase. So the next phase we are going to be taking a look at is chapter 4. But before we do that, let me accommodate 1 or 2 questions, not more than 2, so that we can move faster. Okay, I can see some hands. Please.
Question.
I've not called you. I'm going to call. Please, if you are not called, please don't unmute yourself yet. Thank you. Based on the list here, 1 and 1 about Tommy. Mr. Tommy, you can go ahead. Your name and your location, then you ask your question. Please make it brief. I don't think Mr. Tommy is here with us. Okay, Damilola, go ahead with your question. Okay, these people are, I think maybe they just raised their hand unknowingly. Okay.
So, I never knew I raised my hand. I'm very sorry about that.
Okay, you can put the hand down. Thank you. So, please, you raise your hand as well. Are you aware of that, or you are not aware?
I'm aware, sir.
Okay. So, your questions. Can tell us your location.
Okay, I'm calling from Enugu.
You are joining us from Enugu. Okay.
Yeah. Hello.
Your question.
Okay. Based on your explanation in step in money laundering, the one seen in placing must the person own the business before money will be there.
Okay, yeah. So it is easy that the person owns.
Can you hear me, sir?
I can hear you. I'm answering your question already. So just listen. So
Okay, sir.
the first step, which is to placing, right? So your question is that must the person
Yes.
own a company? So it is easy
Yes.
to launder money when you establish a business. You can't launder money. In fact, it will be easy to even pinpoint to what we are looking, when we are saying that you are laundering money. We want to make an illegitimate money look legitimate. How do you make it look legitimate? Is to pretend as if you are doing something reasonable by owning a business. So people will be seeing you spending money. When they ask you, where is this money coming? You say, actually, you can say I have a business. So that you can easily defend yourself. So saying that maybe you will not establish a business or you will not, it will make you very vulnerable and easily identified to say you are a fraudster. Because the question will now be, okay, you are spending money, where are you getting the money? Are you a trust? Are you a trust guide? Maybe your father has actually placed some money for you. So if that is not the case, then you get an illegitimate money. The first thing is to place by owning an establishment and injecting those money in that establishment so that when you spend, people will not suspect that the money is not clean. Okay, that's that. So the next question, which would be the last one for this session before we move to another topic. Mr. Abdulrahman, can you go on with your question?
Okay. Thank you very much. Good evening, sir. My name is Nohu Abdurrahman. Right now, I'm calling from Maiduguri,
Okay.
Nigeria.
You are joining. Let's
Yes,
say you are joining. You are not calling. You are joining from Maiduguri. Okay.
yes, I'm joining from Maiduguri, Nigeria, sir. Please, my question is based on this money laundering aspect. As in, how would you? What is a step that a professional accountant or maybe an auditor, when you discover that your clients involved in money laundering, what step by step do you need to do
Okay.
to report this thing?
That's
What do you expect to do, sir?
okay. That's one of the things we have said here. You can
Okay,
see
sir.
these parts.
Actually, I don't
One
know
is to
whether it's
report.
my network. I can't see the screen, but I will try and go through it. I can't see it here. Whether it's my network, I don't know.
Yeah, everyone else can see it. Another thing you could do is to join maybe with another this thing. Maybe you can join on YouTube. You would be able to see the screen. So
Sure.
so these are the steps. These are the things you have to carry out. Is to report to a money laundering officer in the firm. And number two is that you do not notify. Can you mute yourself?
All right, sir.
You do not notify the client of it. Then the third one, which has to do with the NOCLAR issue, is you may have to report externally with the external authority. So if this occurs, so those are the things that you have to do. Esther,
All right, sir.
ask your question. People are saying they can't see the
Okay,
screen.
thank you, sir. Good
Is there
evening,
anyone
sir.
who cannot see the screen?
I can't, sir.
You can't or you can.
We
I
can.
I can.
You can see the screen. And so anybody who cannot see it's your network. Okay, go on, Esther, with your question.
Okay, sir. I'm Esther from Abuja. So my question is still on the money laundry. Aside auditors, hello, sir. Can you hear me?
Yes.
Okay, aside from the an auditor, like I work with a real estate firm, and there's a client who
I know, I'm very sure of, is into this and wants to use my company through me. So, but I don't know, how can I, should I just keep quiet and let it go like that? Or how can I, because he wants me to be changing money for him and stuff so much more like that.
Okay, that's why every firm should have a good framework, right? For that. So every firm should have a good framework where money laundering activities. Can you see my screen?
Yes, sir. No, sir.
Okay, wait. I stopped sharing because something else is being shared. So just give me a few seconds. So Esther, back to your question. So that's why your firm, it is not your own activities, right? It's not your own responsibility. Your own responsibility is just report to your own firm to say, okay, something like this is going on now. So your firm will now take it up. So they can decide on what to do. Do you understand? Do you understand?
Yes,
Because
sir, but they didn't do
it
anything,
is
and the person is still messaging me.
not so. So if the person is messaging you and your firm is not doing anything, it's a risk on your own firm. It's a risk on the firm you work with. Or maybe you say a real estate company, right? So I don't know the
Yes,
requirement
sir.
of school. I don't know the requirement of school regarding real estate, whether they have to file or something about that. So, but I feel if something like this is going on and because they will try to look for one place or another to push this money. They want to make it look like it is real. So they'll be looking for every single places to do it the right way. And that's why as an accountant, our integrity is very, very important. The reason why there's a code of conduct that I can use to place or they bring out is for you to do the right thing. So that you don't aid and abet. You don't aid and abet criminal activity. So you could do if you're it's not depending on your own personal value and acceptable standard of professionalism. So you may look out, maybe if there's any better offer where right things. We have seen a situation whereby people leave some companies because they were not complying with the rights, laws, and regulation. And it is a professional issue for them. So they leave and go to a better company. So you could do that. And if that opportunity arises at any time, just jump at it and go to a right company where they do the right thing. So because now this is beyond you, it is not your own company, you can't decide. Do you understand? So you may seek and maybe some other advice from professionals that have experience, that have experienced this, because this is our profession. It's not about book. This one I just reading book. So it's just inside paper. How do you address it in practice when you are faced with this? It's people that are in those shoes that have had experience will give you better advice. Do you understand? So
yes, sir. Thank you.
So let's move on. So I think I may be forced to now to mute all our mics so that we enjoy ourselves. So we are moving to, so in the next 1 hour, we'll be having a look at chapter 4. So what is chapter 4? Chapter 4 is professional responsibility and liability. Auditor's liability in another word. So this is we're going to start with audit expectation gap. As the name implies, expectation. So expectation leads to disappointment. A whole lot of people are disappointed at auditors. I'm very disappointed at you. Why? They are disappointed at auditors because they expect some things from auditors, whereas they witness another thing. And they are disappointed. So, and that is why there is a chapter that has come to address this. People expect too much. or they expect wrongly from auditors. Let's put it that way. They expect wrongly from auditors. This is used, the audit exception is used to describe the difference or gap between what users of financial statements expect of auditors and what auditors are actually required by law or by professions to do. Audit is a statutory exercise. The law requires it. Also, the profession also guide the profession in terms of ICANN, IFAC, and ISAs, all those things. They also guide how auditors should carry out their activities. However, the public, the users of financial statement, are expecting something else, and they are disappointed. Why disappointed? Because you expect wrongly. We are meant to do something else. You are meant to do one thing. You guys are saying this is what we should do. For example, number one example, the public believes that it is the responsibility of the auditor to detect and prevent fraud. And that is the sole purpose of audit work. All they know, some people, is that auditors, we want to go and catch thief. You are not a policeman. You are not a forensic investigator. There's a clear responsibility initiative. There is something, it is clear. What are you coming here to do? Is to ascertain the true and fair view of financial records. It's not to come and detect nor prevent fraud. That's the first example. The second example, they believe, the public believes that audit opinion can be relied upon for every possible decision, including decisions for takeovers. Once they pick up the financial statements, they believe, okay, since the audit opinion has said, okay, all those things that they use in audit reports, stating their own opinion about the book of the financial records of an organization for a whole year, and they will take it by face value that is fine, and they use it for takeover decision. And in the end, things go gaga, and they will now come and say they have relied on the audit reports. It doesn't work that way. It's an example of expectation gap. Audit opinion is not to be relied upon for every possible decision-making exercise. Number three example is the public believes that auditor carries 100% test of transactions. This could be possible for a small entity, or for a big company, they cannot carry out 100% transaction. The sample. Based on maybe the sample, they use different criteria to sample to carry out the sample of transactions they test based on materiality, depends on threshold, it depends on TA. That's it depends on TT, test of error acceptability. So there are quite a number of tests that they do. So it's not 100%. That is about that. Then, what are the elements in the expectation gap? What are the elements in the expectation gap? Number one is the standard gap. This occurs because of a perception that auditing standards are more prescriptive than they actually are, and that they have wide-ranging rules that they must follow. Standard gap. We are talking about auditing standards here. The same way as accounting standards. There are rules, there are principles, they are principle-based, not rule-based. And there's a gap. Because in principle, you can bend it. If you have proper reasons not to comply, it's either you comply or you explain. That's it. It's comply, or if not, explain. As against rule, there is no explanation. You just follow it. The second element of expectation gap is performance gap. This happens because of perception that audit work has fallen below the required standard. So there's a performance gap to say what's the extent and audit work to have done and what they are doing. So the third one is liability gap. Liability gap is when there's a lack of understanding about who auditor is liable to. Auditor is liable to shareholders, not every single person out there. So it's only shareholders or a potential shareholder. In fact, you two are even potential, you can't hold them around some. It is the shareholders. The essence of auditing or audit exercise is to protect shareholders' feelings, shareholders' money that they are put down. So that the ones which we use justifiably. So a high level of expectation concerning what auditors should do may lead to legal actions against auditors. So to maintain the image of the profession and to reduce frequent costs of legal action, those gaps need to be closed. Now, how do we close expectation gaps? We have to use the following strategies. Number one, improve the general level of knowledge. Make people aware, sensitize them. Control over auditing profession. There has to be regulation. The one that FRCN is expected to do or is doing, they have to regulate. They have to regulate audit profession. And also ICANN as well, as the body that regulates audit profession. The body that rolls out, that certifies people that are auditing. They have to control and make sure that the right people are the ones that are carrying out auditing in different industries and ministries, or let's say in different organizations. Number three is to increase the focus of corporate governance. It's very important. When there's a strong corporate governance, things should be done in the right way. Open and candid information between internal and external auditors. So internal auditors are there to aid the external auditors. So if the internal auditors carry out the activities or their responsibilities properly, it's going to, the work that external auditors will do, they will do it seamlessly, risks will be reduced, and there won't be any funny outcome. Okay, let's move to another concept, professional skepticism. I like this particular concept. Wearing a skeptical mind. This is the possession of an inquisitive mind, a questioning mind by an auditor in carrying out his audit assignments, having it in mind that there could be any possible fraud or error or irregularity. It also involves critical assessment of audit events. So you are in a firm, they are carrying out audits and they are giving you everything, and you are certifying, it's fine. Why are you there? What if they are giving you the wrong thing? So that is where professional skepticism comes in. To say, no, you do not just take things by face value. You have to understand. You have to have that questioning mind, inquisitive mind, that it could be wrong. So, and this is usually demonstrated by communication. You ask questions. People that handle auditors in different organizations, they know about this. Especially those ones in the Big Four. Sorry to say, they can be so annoying sometimes. We can be so annoying. We can be so annoying. Why? Because we have to be skeptical. And it's not our fault, right? We are here to protect some persons. People have put down their money, right, for the sake of doing business. So, okay, now you guys are here, you are keeping records, and some things we do not understand, we ask questions. Number two is documentation. You keep proper documentation, otherwise auditors will stress you. They will stress you, and you won't finish on time. And it will disrupt your own business as usual in the company. So the proper records you keep, the less questions you will answer, the less stress you go through. Number three is use of persons with specialized skills to work on specific areas of audits. This is for firms. So that is where the specialization initiative has come in to say, okay, some persons are in energy, some are in consumer, some are in financial institutions, some are in telecommunication, so that they can specialize. The more they do, the more they know. And 4 is to consult with more senior partners. When you have a doubt about something that you are not clear, that's why you have your colleagues, your senior colleagues. If you're in training, you consult with a senior, or if you're an associate, consult with your senior colleague. Senior would consult and ask maybe more questions, clarify maybe from a manager clarifies from maybe the senior manager. So you consult to your higher or your senior colleague. Okay, let's go to fraud and error. Okay, yes, we have said that auditor is not responsible to come and detect or prevent fraud. However, ISA 240 has done something about said something about fraud and error. What is a fraud? According to that ISA standard says a fraud is an intentional act involving 1, falsification of records or documents. You intentionally falsify records is fraud. Number 2, deliberate incorrect application of accounting policy. You know that this treatment is not correct. IAS 16 says this and you're doing otherwise. IFRS 16 says this and you're doing otherwise. It is a fraud. Because what is the essence of accounting standards? The essence of accounting standards is to protect investors, is to protect shareholders. So you going against principles or the provisions of those standards, it means it's tantamount to fraud. Number 3 is to misappropriate assets and funds. Assets are those things that represent shareholders' investments. If you misappropriate assets or funds, it's a fraud. Spending lavishly, you are using properties inappropriately, it's a fraud. Okay, what is an error? Error is unintentional. Fraud is intentional. Error is unintentional. Misapplication of accounting policies, oversight, or misinterpretation of facts. When you misinterpret facts without knowing, then we call those an error. Okay, what is management responsibility regarding fraud and error? Management is the one responsible for preparing financial statements. So they are the one responsible to prevent and detect fraud by putting in place adequate internal controls, which is a good mechanism, and that's the best way to prevent or detect fraud is to have a good internal control system. So auditors' responsibility regarding fraud and error. Auditors, what is your own responsibility? My responsibility as an auditor, it is to obtain reasonable assurance that the financial statements taken as a whole are free from material misstatements, whether caused by fraud or error. It is not the primary responsibility to detect or prevent. So what we are saying here is that your own is to make sure that the books are properly kept. No misstatements, whether intentional or unintentional, there should be no misstatement. So in that course, you may now detect fraud, but error, you have to detect error, right? To a reasonable extent, the financial record needs to be correct. Okay, what is the procedure where fraud is suspected? Identify possible impacts of the error or fraud on the financial statements. Number 2 is to consider its impacts. To consider its impacts on other areas of the audit. Discuss the findings with the management. Determine action that the management should take. If it involves the management itself, decide the best course of action. Maybe you can just resign from that exercise. Then number 6 is to consider the impacts on its reports to the owners. Note, the auditor should perform the audit with a suitable degree of professional skepticism. So once you are skeptical, you wear that in mind. Even if the book is given to you by your father, by your mother, you have to be skeptical about it. It is your profession to be skeptical because we are talking about financial information, things that can land you behind bars if care is not taken when you do the wrong thing. Seen situations whereby senior officers in all these firms are being jailed because of this auditor's liability. It's a serious issue. And some that are not being jailed, they are fined severely that it shakes, it affects their financial stability. So it's a very serious issue. Okay, now let's move to auditor's liability. We have talked about expectation gap, how do we close it, professional skepticism. What is auditor's liability? The situation where auditors are held responsible, liable for any damage as a result of exercising their audit engagement. This can lead to a legal claim against audit firms, which can either be a criminal act or a civil act. So what we are saying is that auditor's liability is a situation whereby auditor is held responsible. Maybe he's sued. Maybe they press a legal action against him. So this can be of two reasons. So the liability may be a criminal, maybe the case is a criminal case or it's a civil case. So the following are examples of scenarios where auditors may be criminally liable. Number one is accepting an appointment as an auditor under a statutory provision without necessary qualification. You have not qualified as a chartered accountant, and you are accepting an appointment to act as a chartered accountant to audit a firm. Where is your license to practice? So it's a criminal offense. Number two is where the auditor himself is involved in fraud. Maybe a company is paying you to cover some things for them, and you accept it. Number three is where the auditor is seen to have aided or involved himself in the money laundering activity. It's a criminal offense. And the implication of criminal offense is that it can land you in jail. That's the essence of it. Civil offense, maybe a fine, a sanction, or a damage may be paid to the party involved. Okay, civil liability, any legal claim made against them as a result of negligence or duty or carelessness. The auditor can delve into this in two possible ways. Number one is a contract law. The company has a contract with external auditor for the provision of audit and assurance services. So it can sue the auditor for any breach of contract if they get. Under the law of contract, only the company can sue the auditor and the one we know as what? Letter of engagement, right? Which is going to list out your terms of service, your activities, the amount you are going to be paid. It will be there. So that LOE, that letter of engagement, serves as a contract between you and the company. So it is only you and company that have entered into contract. So any third party that has come to say, okay, I relied on this audited financial statement and this, and cannot sue you. So you are only liable to the company. So Awani, according to KAMA 1990, auditors can be sued for shareholders in the court of law. So as an auditor, you owe your client a fiduciary duty, a duty of truth and care. That's why professional competence and due care is very important. Also, to have such, working paper files should be kept safe as evidence to support his opinion. Well, this is very, very important. You keep your working papers. So now working papers are now digitalized. So we have moved ahead from the era of papers. So many big companies now, big firms rather, they now use an automated working paper. They keep the records there. So as for small firms, they still maintain some files where some files are being kept, right? Though for 60 years, as the party says, some have maintained 7 years. So beyond 7 years, they will just some will just they will just trash some of those records. So if you come back and say, okay, these are okay, the files are no more available because they have trashed them. Law of thoughts. This is a branch of civil law which allows any third party who has suffered loss to also sue the auditor for damages due to his negligence. The banks, creditors, other companies, any investor relying on financial statement for lending, take over bids or investing in the companies. Okay. Continue to be met before someone can make a claim against auditors in negligence of thoughts. We understand the fact that the person that directly engaged auditor can sue if the auditor is negligent. Okay, however, when we now say under law of thought, a third party can also sue, how does this go? What are the conditions before a third party can jump to come and sue an auditor? Number one is that the auditor must owe duty of care to the person. And number two is that the duty must have been broken and a loss now arise as a result of that. So a third party can then say they will sue the auditor. Okay, we've seen this, a whole lot of cases that goes on in parties, people, auditor having a legal suit with one particular company or one particular set of people. How do they go about it? So in a situation, sometimes it can lead to out-of-court settlements. In large cases against auditors, as anyone sees a high publicity, but many other cases are not widely publicized. You may not know. Often because they are usually settled out of court. Just go to court and then, okay, this person has suffered damages, pay for that damage because of your own negligence. So they settle out of court and they pay. So advantages of settling out of court, it avoids cost and time involved in court cases. There is no time. You'll be going and coming back from courts. So all those are avoided. You settle out of court. Number two is to avoid adverse policy of the auditor. This could lead to a reputational damage for auditors. So it's advised if you have the ability to just settle out of court. Number three is the final settlement is lower. If you realize that in the end, this does not, the settlement or the damage is small compared to the time and energy that you wasted, just settle out of court. Disadvantages. It may encourage others to take actions against auditors. So if people are settled out of court and companies realize that they are getting a huge amount of money from auditors, others may take suits and say they want to be suing auditors. Insurance premiums may rise. We are going to, I think the next concept, we will look at the concepts where we are going to be discussing about auditors insurance. So there is an insurance that audit firms now pay to guard against legal actions like this, because sometimes those fines might be stiff and huge. So once they have an insurance, a policy that they are paying, can assist them when those fines, sanctions arise. It makes the legal position unclear. If they are settled out of court, we would be so unclear, it will be ambiguous on what has actually gone wrong. You won't know because there is no verdict that has occurred. They are settled out of court. Who is wrong? Who is right? The question remains. Okay, use of disclaimer clause. This is another trick, or let's say another tip that auditors may use so that legal action will be reduced. Number one is to reduce the risk of legal claim by the third party, is to disclaim the audit opinion by saying auditor's report is for the use of the company and its shareholders alone. So any third party that is any third party that is making use of that audit firm, of using the audited statement, knowing that there's already a disclaimer of opinion there, It's just on its own. No responsibility is accepted to anyone else for the contents therein. That is the essence of disclaiming an opinion. The auditor have saved himself some risks by doing this. Okay. How do we manage auditor's liability? We can do that in 3 ways. Number 1 is to avoid the liability totally. Number 2 is to meet claims. Operational indemnity insurance, PII. We are going to come here later. Then to limit the liability. So you know that, okay, you may not avoid totally, you can limit it. Avoiding liability, how do you avoid? You avoid by following appropriate standards, effective quality control. You avoid liability by training your staff appropriately, and you ensure up to date with modern audit regulations. That is how you avoid. Number 2 method that auditors manage their liability is to use professional indemnity insurance, PII. The one I explained the other time. This arises as a result that auditors might be asked to pay damages more than what they can afford. So some damages may question or may affect the audit firm's going concern. So in that case, they use the professional indemnity insurance to carry those out. So in order to avoid that, an insurance policy is bought to cover against such liability. Then if such liability arises, the money is being paid by the insurance company, not the audit firm. What is the disadvantage to this? Is that it may encourage careless audit exercise. Because audit firms now know that they have a huge amount of insurance premiums that have been paying month in, month out, and they have not been using it. They may be careless in carrying out the audit exercise. It imposes high cost of audit fees. So if the auditors know that they are paying insurance, where will they be getting the money? They can increase the audit fees, and it is an increment of expense, of audit expense to the organizations that are giving services to audit firms. Okay, liability limitation. How do you limit liability, which is the third way of managing auditors' liability? Is to achieve this can be achieved if the government of the country allows audit firms to have a liability limitation agreement with clients. For example, as a client, you cannot sue for us. You cannot sue us for more than so percentage or after so number of years. So they have limited the liability to say after 6 years, you can't come back to say something is wrong with this accounts. Okay, for more than this percentage, you cannot sue us if anything goes. So this would have been embedded in the LOE or in the agreements that they are signing with themselves. Other ways to reduce auditors' liability is number 1, to make directors have indemnity insurance as well. And number 2 is to make audit firms limited liability partnership. So which some countries have adopted actually. It is a form of partnership that is limited. What we know as a characteristic of a partnership business is that the liability is not limited, unlike companies. There's a limited liability. Your liability is limited to the amount that you pay as a shareholder. So they can't go beyond, except in some rare cases, where they might now have to lift the veil of corporation. So they are trying to adopt that same stuff for auditors, because we realize that if anything occurs to partnership, because they are partnerships, they have come together, their liability is not limited. This may affect their personal finances or personal money, and they will be liable to now pay more and render them bankrupt if care is not taken, it's not properly managed. And that's why we now say, okay, there should be a form of partnership that will be limited in nature, where your liability will not be limited. It will be limited to the contribution of each partner in the partnership business and not their personal property. You see this thing. That's the essence of making audit firms an LLP instead of just normal and co. And that is why some firms, what you will see after their name is LLP, they will say so and co. We say so associate LLP. That's some firms are now adopted that. It's common in some countries, maybe in the UK it's common. Now Nigeria has also adopted it, right? By virtue of the new, I think maybe the new panel or so, not certain. So but it has also been adopted. Yes. So, ladies and gentlemen of professionalism, this is where we will stop for tonight. Right? I'm going to dash you the remaining minutes for us to. So I'm going to take questions from now till 8:45, so that you guys can prepare for the next class. You should be having SFM class after this, right? And you can also go and prepare for your studies as well. Thank you for your decorum, your attentiveness. I appreciate that. Then let's accommodate one or two questions. Please, if you have questions, raise your hand. If you have questions, raise your hand. I don't want to assume that those hands that I have up here are previous hands. So while we are addressing those people that will ask questions, can you clap for APES? Using emoji, clap for APES Professional Associates. Clap for APES Professional Associates. Show love, show love, show love, show love. And also clap for yourself. You guys have done well. Have done well. People have been expecting class before I even got to class. They are seated. The moment I drop the link like this, the class gets filled up, guys. Thank God for YouTube. Thank God for YouTube. Okay. I'm going to be calling. Okay, those people that we did not call the other time. Kind are they doing? You will go first. And you state your name and your location, then you ask your question. Some persons I can see they are dropping questions in the chat box. Let's take Kenny first. Kenny, you have the floor. Hello, Kenny. Are you there? Okay, let me call another person. Right. Perhaps that was a mistake. I believe people can unmute yourself, shall because I've allowed that. Okay. But John, ask your question.
Good evening, class. My name is Agba John, calling from River State, joining from River State.
You are joining from River State, okay?
Yes. I wish to ask question in auditor liability. Like,
okay,
what you were explaining, you made mention of an not qualified auditor, somebody who is not a chartered accountant yet is working in a firm where he is auditing in a civil.
I don't think that's what I said. Though. Nobody says you can't work in another firm if you are not qualified.
You said he can be sued.
No. So what we are saying is that a license to practice as an auditor, someone will get it, right? Maybe a managing partner or so. So if you do not have that license and you are practicing, so it doesn't mean that maybe you that as an employee you are working there. Is it that you can't work without being a chartered accountant? No, that's not the case.
Okay. Okay, that was the.
So that answers your question.
Yes, sir. Yes, sir.
I can see some echo from your background. Okay, let's ask. Let's allow other person. Can you mute yourself, please? Thank you.
Yes, sir.
So, Abdulrahman, no, you can go on with your question.
Sorry, I didn't know I raised my hand, sir. Sorry.
Is it an old hand or a new one?
Sorry, sir. Yes, sir. Sorry, sir. Yes, sir. That's the one.
Not you, Abdulrahman. Amabukola.
Yes, sir.
Is it an old hand or a new
No,
one?
it's a new hand. It's a new hand. Yeah, from your explanation,
Okay,
you
go on
said,
with your question.
all right, from your explanation, you said audit firms, like they're now forming a limited liability partnership. And I could remember from your
Okay.
previous class, from the previous class you had with Auditor, in terms of auditing audit firms, they are firm and not a liability company. Now that all these firms are now forming up to be a limited liability partnership, does it mean that they will now be audited? Or
It's not liability. It's not limited liability company now. It's still partnership. So it's different.
different? All right.
Not company. It's not a company. So it's different. So that answers your question.
Okay. Thank you, sir.
Okay. You are welcome. Let's take theft. Kindly unmute and ask your question. Don't know if I'm pronouncing the name correctly or Maurice Tekte. Okay, I think maybe you mistakenly raised this hand. Let me lower it. Kind of doing. Are you ready now? Okay, let me lower her hand. Abiodun Fatima. Unmute yourself. Please, let's be ready. Okay.
Hello, can you hear me, sir?
Yes, your name and your location.
This is Fatima from Lagos. So,
Okay.
the question I have is regarding fraud and error. Is it possible we have a situation where we are trying to figure out if the activity or the transaction done is an error or a fraud? Do you get what I'm trying to say? Maybe we can't specify the transaction as a fraud or either an error, but it falls within the two. How do we tackle such situation?
Well, it's simple. Whether fraud or error is still a misstatement, and it has to be addressed. So if you cannot pinpoint which of the two it is, so just focus on how you address it, right? So but disregard you, and anything that is intentional is fraud. So anyone that is unintentional, maybe they just mistake unintentionally, maybe there's a knowledge gap, maybe they do not have much experience, or it's a new regulation, or it's an omission. So those ones you can say is an error. If it is intentional, it's a fraud. However, the ruling line is that whether fraud or error, the financial statements should be correct. And that's why you are there. Okay. Raika, you can go now.
All right, good evening, sir. I'm Walter from Enugu State. The question I want to ask is, I want you to tell me whether there's a difference between partnership and then limited liability partnership, and then generally differentiate between a partnership and then a PLC for me, please.
I think differentiating between a partnership and a PLC company is a basic discussion. I don't think we should be having that discussion. This is an advanced class, right? We know a partnership, different persons have come together with a business idea, right? And what we know before is that they are not companies, they are not limited liability companies. And what's the essence of the limited liability company? What it means is that the company is proceeds, right? When maybe any of the owner, even if any of the owner maybe dies or something, but the partnership, we know that there's a whole lot of things that may trigger or affect going concern. Like for example, if a partner dies or a partner withdraws, it can affect because it's just a step ahead of a sole proprietorship. So proprietorship is one man business. If that man dies, the business dies. Partnership is could be two. So one of them dies or one of them pulls out, it can affect that partnership business. So a limited liability company is a proper setting of a business, right? Where there's a whole lot of things, advantage, the shareholding, there's a quite number. So now the limited partnership is just to limit the liability of partner. It's still partnership, it's not a company, right? There's no flotation, there will be no shareholders meeting, there's no AGM, all those stuff will not be there. So the fact that company is obliged to audit, it's not there in partnership, right? All those things are not there. So there's a whole lot. It's not because a partnership, whether limited partnership or one that's not limited or just ordinary partnerships, are not guided by karma. But I know a company, right? So it's only to limit the liability when there's an issue, so that they won't go after their personal money or personal belonging. That's just this. That's just, but it's still not a company. Okay. So I think that is the last question. This is 45. For those of you asking about the summary notes, as we said the other time, summary notes are available 2.5. Reach out to get it, the soft copies, right? Soft copy. Other summary notes are also available, but we've not started giving them out because there are quite a number of messages I have now. I want to address them. So because this is what we are using, you guys want to be reading ahead so you can reach out to get the summary notes for advanced and audits. And for maybe another question that you may share was for advanced audits in particular, so you can get it right and read ahead. So thank you so much. I remain my humble self, just in professionalism, KABIRU Yusuf Aremu, ACA, ACTI. You continue your class on Friday with Mr. Idris, and then perhaps if God wills, you may still see me in classes going forward. Thank you all. Thank you all. Thank you all. Enjoy the rest of your evening and prepare, get ready for your SFM class. Thank you so much. Good night.
Thank you very much.
Thank you, sir.
Thank you very much, sir. May God bless you.
Thank you very much.
Thank you, sir.